We have the usual fantastic array of investment bankers to talk to you about the topic. So to my immediate left is Christa Volpicelli of Citi. We have Jay Kwon, DNB, Doug Mavrinac, Jefferies, and Mike Kirk at RMK. Hopefully they're all well known to you all. So I'll start right in. I wanted to focus on the equity markets initially in our discussion. Obviously the last couple years have been a story of difficulty in capital raising for shipping in the capital markets, in equity, and in New York in particular, perhaps. So I'll ask each of the panelists, where do you think we are now in the equity markets in particular? And if you could take a look around the corner and tell us where you think we're going next in the near term. I guess, Christa, do you mind starting off?
Sure, I'm happy to.
You're immediately at hand.
So where are we today? Well, we are certainly in a backdrop of strong earnings in sectors like tankers, and so that has been driving up stock prices pretty dramatically, so that we've reversed course in terms of that segment of the market today, now trading above NAV, where for a pretty long time most companies were trading below. We have come off of a period for really the last 4 years in the U.S., where U.S. equity issuance volumes have been at pretty poor levels. And that's just been a function of the underlying performance of all the companies. But I would say, separately from what's happening right now in the tanker markets, we have felt quite positive as we head into 2020. We've been out doing a survey with investors in the last couple of months and do believe that investors are looking to put money back to work in shipping. I think there's general consensus across many of the sectors in terms of what the backdrop is for tankers. I was here for the dry bulk panel, and certainly you heard the owners quite positive there in terms of what happened to earnings, and ultimately it is increased earnings that will drive stock prices upward. So I do feel confident that we will start to see investor interest come back. I think, though, that it is changing a bit, and I'm sure as we go on we'll talk about trends of consolidation, and you heard it on the banking panel just ahead of this, that larger companies that are public can attract more capital sources, and so we do think that there will be increased differentiation of value for companies in the markets, but next year should be a much better year, we all hope.
So do you, in these surveys, are you hearing sort of an overhang of uncertainty about IMO 2020, or is that all priced in?
No, I don't think IMO 2020 is all priced in. I think that we're now getting to the point in time where we'll all see what it means, right? We'll see how it translates to differentiated earnings for companies depending on their strategy. For the moment, it's all been listening to speculation around what will happen, and so we'll see that and we'll see it come through. So I think we're now at a point where we should see that bear fruit in terms of differentiation of earnings.
So heading down the road, Jay, a picture has been painted of general optimism in the shipping. Do you agree?
No, we agree, and having lived through this for many years, as Christa and many of my colleagues have lived through for the past few years, just the difficult shipping market. I think there have been pockets where we have been able to raise equity, but it has been much more difficult. But clearly, what we've been seeing recently with the tanker stocks certainly running up, I think there has been some increased attractiveness and focus around the tanker space. But generally, I would say that we are seeing right now, I think, people looking more attentively at this IMO 2020. You mentioned that. I think we are waiting to see whether or not this is a real impact or a game changer heading into 2020. And I think people, some are on the sidelines just waiting to see whether this is real, and others are starting to make their bets. So I'd say that if anything, even prior to this tanker run-up, we have been starting to see some of the long-only guys who have typically shied away from shipping, I would say, over the last couple of years, starting to ask more questions and spend more time in the space, and not just in tankers, but across the different parts of shipping. And so I think that has been actually quite encouraging. But time will tell as we head into 2020 what that means. We definitely agree that the larger tanker, larger dry bulk, it's the larger market cap names who I think will certainly have a real distinct advantage, and I don't think that's going to change anytime soon.
Doug, please.
Yeah, maybe adding a couple of additional thoughts to what Christa and Jay have already provided. But Christa mentioned about how paltry the capital raising environment has been in the public markets over the last couple of years. And while it has been paltry, there are investors that were looking for opportunities. So our firm personally, we were involved in the Genco follow-on as well as the Eagle convert, so equity linked. And so investors are there for the right opportunity, the right combination of sector management, use of proceeds, et cetera. So those investors, they just are looking for, once again, the right opportunity. When we look at what's happening today and talking about what's coming around the corner, everyone in this room knows about how strong the tanker market is, and everyone with a screen can see how the equities have been responding. Much like Christa and Jay already mentioned, the market is quite strong, but other things that we look at that I think may be useful for members of the audience is, when you look at companies that are attending today and the one-on-one schedules and the number of guys that they're meeting with. Our own analyst was on CNBC yesterday, and you're starting to see the Wall Street Journal and Financial Times picking up stories on the strength of the shipping market. And those sorts of things are very important in terms of affecting successful transactions, because it's not just looking at the narrow shipping only investors that you're now talking with. Anyone that's watching CNBC or reading the Wall Street Journal is now realizing that something positive is going on in the shipping markets. And when you're looking at affecting positive capital markets transactions, oftentimes it's those additional investors that are required for the best execution. So we're quite optimistic, not just because the market is good right now and you're starting to see the necessary ingredients for successful capital market transactions, but when you look at the fundamentals, when you look at these restrictions that have been put in place that are largely responsible for the strength, they're not coming off in the next couple of weeks. And if anything, if you look at the strength of the market and how some of the owners are reacting to delaying scrubber installations until next year, that's just going to extend how long the market is tight. So we're quite optimistic, and we think all the necessary ingredients are there for some successful activity.
So Doug, you said there's more attention being paid. I guess I'll sort of just skip topics and ask you to speak to, has the retreat of analysts, dedicated analysts from the space, sort of affected that as the market thaws?
Yeah, as probably some ship owners can relate, if you're one of the survivors through a nasty downturn, you're positioned best for the upturn. And while, as an industry, losing a lot of analysts is not positive, because I'll tell you, pushing shipping equities over the last 10 years was a challenge. When I say pushing, I'm talking about talking to your 50-something sales guys or 100-something sales guys, whatever number of sales guys are at your firm, and trying to get their attention to go out and make a call on a positive dry bulk market or a positive tanker market. That's hard. And so whenever you see your competitors and other guys not doing that anymore, then the investor at Fidelity or Wellington isn't getting that call anymore, doesn't know what's happening. So it makes it difficult for the industry, but for guys that are still committed to the space, it is a positive. But just as an observer, so not just a participant, but as an observer, I can't imagine a worse time for our competitors to capitulate.
Mike, do you want to speak to the big picture?
Sure. I think the really interesting thing recently with the crude market and to some extent the Capesize market is the reintroduction of upside volatility. I think investors were all too aware of downside volatility, and when you pitch them on ideas and things, that would always come up, but everyone kind of forgot the upside. And obviously we're seeing it in some stock price moves, but also, we just had a conversation recently on a deal unrelated to the crude market, but there was a convertibility feature, and the investor was saying, well, my committee is not really going to give much credit to the upside case. And then we said, okay, well, maybe we'll just take that away and we'll increase the coupon. And then it was a quick no. Whereas I think 6 months ago they would have been happy to take that trade. So I think people are realizing ships can do what they're doing right now, and there's a lot of if you're well placed in the cap structure, there's a lot of interesting upside in the equity. So that's a positive.
So a couple of you, or almost all of you, have touched on consolidation and the benefits of size as a differentiator. Certainly we've seen a lot of that in the last couple of years, M&A and share-based asset acquisitions, ships for shares. Is that trend continue? Have you seen proof of concept? Have the larger companies been rewarded? Or are we still waiting to see how that plays out? Why don't we sort of go in reverse? And Mike, do you want to talk about that?
Yeah, I think it'll continue. I also think it's heck of a lot easier now if companies are trading above NAV. It makes a ship for share that much easier. And also we might just get some separation where, even public company to public company transactions can make sense. So everything's easier on the M&A front if you're trading above NAV.
Right. Doug?
Yeah, agreed, and I can say firsthand that we're having many conversations with many owners on that very topic of looking for M&A opportunities, and ships for shares, cash, et cetera. Everything is on the table. So, and that was prior to the recent run-up in the tanker market. I mean, I'm talking, every sector within shipping, those conversations are being had, and I do think it's with the recognition that bigger is better. It's 2005, 6, 7. I mean, you could take a 6-vessel public company public.
Sure.
You can't do that now. I mean, there are certain minimums, and because investors have seen that shipping is cyclical, and so it's important to be able to get in. They need to be able to get out, and so size is ultra important. And I think if you see things like what Scorpio's done very recently,
Yeah.
Large companies can do those sorts of transactions that may be more difficult for smaller companies.
Right. So, Jay, the last panel put out as a threshold a $2 billion market cap. Do you think that's the size threshold that we need and we see benefits there?
Well, I think let me start this way. I think when we have been talking to companies about looking at an IPO, we have really started increase the threshold. I think it's hard to say that there's a hard and fast rule that you have to be $500 million or $1 billion market cap, but I think what's very clear is that companies who are able to transact are the ones who are billion plus market cap companies, and even before this run up as well. I think the other part I would say is Doug mentioned this. I think the discussion around consolidation. It's interesting because there was a point in time, I'm sure some of you remember, where it was all about pure play X, pure play Y. I think what you're seeing now is there's a more focus on size and liquidity, and so you don't necessarily need to be a quote-unquote pure play, but I think there are, as long as obviously within the sector, whether it's in the tanker or the dry bulk sector, you can look across different class sizes, and that doesn't necessarily, necessarily penalize you from an investor perspective. It actually improves your liquidity and makes you a much bigger company. So I would say that that's probably more the focus. I don't think it's, clearly with the nice run up, we're seeing some companies that are now $1 billion, $1.5 billion, $2 billion market cap, and that's going to just benefit the industry more and more, and I think make those companies much more attractive in terms of potential consolidation for smaller names.
Thanks. That's interesting. So, Christa, you already made this point strongly. I assume you agree with everyone about the benefits of size and consolidation.
Yeah, I do, and I think you've seen it proven out in the equity markets. If you go back and study the stock price performance of the companies who have announced transactions, you will see a very clear pattern of stock price outperformance and a positive share price reaction across the board to most of the transactions that have been announced in the maritime sector. And so I think this is something that investors are embracing. They see the benefits of it. And it's not just about the liquidity in the stock, which I fully agree is very, very important as we all are attempting to attract more investors in the space, but it's about building a platform that is set up for what shipping is going to be in the future and having the financial resources to be investing in what's next, right? Thinking about how you're going to get your company to meet the new IMO standards, to think about how you can embrace technology and have the resources to be investing in terms of managing your business more effectively. And companies that are operating at a smaller scale just don't have access to the same resources to leverage across a bigger platform. So I think your investors see the potential of what larger companies can do with the scale of their balance sheet and spreading out costs across the overall platform.
So, I mean, could you speak then for a minute about, as the market thaws, other differentiators other than size, perhaps that size unlocks for you? I mean, you mentioned technology, and green shipping was discussed in the last panel and the investments that are necessary there, but sort of near term, what are other differentiators? Is it, corporate governance? Is it more of a cash flow dividend story? rather than an asset play? I mean, what else do you see being the focus of equity investors going forward?
I think the focus is really back to basics in terms of proper balance sheet management, having a dividend policy which is not overstretching the balance sheet but is appropriate for the cycle. I think as a general statement, many investors and analysts are expecting dividends to pick up next year off the back of a stronger earnings environment, but no one's expecting a return to a full payout model where companies are paying out more than they can actually sustain for an asset that has a finite life. So I think it's important that, financial policy is prudent, good corporate governance, themes of ESG, that are kind of percolating through the sector and in the financing markets. That's increasingly a focus for both debt and equity investors. And you're seeing more and more companies in shipping, try to make that part of their investor dialogue about the things that they are doing both internally and externally towards those initiatives. And those are themes that are increasingly resonating in the markets.
Even in the short term, not just in the 5-year window.
Yes.
Yeah. So, Jay, any other factors that you would like to emphasize?
I think it's, as Christa said, it's
Yeah.
back to basics here. I think once we start to see the earnings ramp up, and again, this is why we were saying earlier, people are sort of sitting on the fence to see what the real impact of IMO 2020 will look like. We've seen, obviously, what's happened with the sanctions has really driven the current excitement around the tanker names, but again, that hasn't necessarily factored in the IMO 2020, so I think that's going to be a key factor for investors. The other thing which we are hearing more and more about, and I think issuers are hearing more and more about, is the ESG topic, which I think probably a couple years ago was probably not something that was really mentioned in either investor meetings or frankly across different banks, but I think that is becoming a much more relevant topic, and I think many companies are taking a much more proactive stance to address ESG with many of their discussions. Many of the one-on-ones today that are happening today, we know from talking to companies previously that they were saying that they're hearing more and more from investors that they would like to hear more about their ESG policy. So again, this is something that I don't think we had really anticipated a couple years ago, but I'd say that that's definitely an important topic, and I would say that could become more important in terms of investors' decision.
Doug, would you like to add anything? And,
I would concur with both what Chris and Jay said. I mean, to me, one thing that's not controllable is the sector that you're in. I mean, you make a decision on whether you want to be a crude tanker or a product tanker, but once that decision is made, obviously the sector fundamentals will have a big impact on the success of any sort of offering or any sort of transaction. But the other is just, once again, echoing, just management, financial discipline as a function of management. And, over the last, I was going to say several years, but almost been a decade, it's been about, how do you manage your balance sheet? But now you're going to be seeing a lot of companies generating a lot of cash over the next quarter or so. It's how do you deploy that cash? Do you delever? Do you grow, prudently? Do you return some of it to shareholders? I think that would be something where, if it was done prudently and reasonably, investors would probably receive very favorably. By no means kind of advocating some sort of full dividend payout model, but, a little bit of return of cash to shareholders, either in the form of buybacks, which, on paper sounds great, but effectively it hasn't been as successful as dividends. So, just, management and everything that entails.
Yeah. And Mike, I mean, just speaking to any of these points, or do you see that sort of as things thaw, the IPO window opens, or do these sort of interest flow to the surviving companies?
Yeah, I think the focus is going to be on the surviving companies for the near term. I guess as we go down the table here, I'm the opposite of, I think full dividend payout model is a great idea. I think people should do it as long as you have low leverage. I think the market needs different types of models. First of all, no public shipping company is a ship owner. There's no asset play from a company perspective. They don't sell ships. The asset play is the shareholders. The shareholder can buy and sell shares whenever they want. So you want to give people different models within the market. A full dividend payout's one. Another one might be a charter strategy. Another one might use that cash. But it's a lot easier to grow when you talk about these big, expensive assets with equity issuance. And the only time we really can see consistent outperformance to NAV is with the full dividend payout model. So I think that's the way to go.
Right, and we've been maybe implicitly sort of discussing the U.S. markets. There's been more activity in the Norwegian markets lately. How do you see that going forward? I mean, Jay, maybe you want to speak to this from DNB's perspective?
Sure. I think the Norwegian market has certainly picked up a lot of the slack. I think maybe when the U.S. market has been a little bit weaker. I'd say within the Norwegian markets, and I think we may discuss this over the last 12 months, we have seen a lot of activity, certainly on the fixed income side. I would say that has been a market that many issuers have taken advantage of. And as most people know, one of the benefits of the Norwegian bond market is that you can do much more customized, sizable offerings, whereas in the U.S. you typically would need to have at least the 250, 300 million bond offering to make it attractive for U.S. high yield issuance. The other thing, of course, is the absence of ratings, and so we have seen several companies just continue to access the Norwegian bond market, and I think that's going to continue because it's, for many of them, they're repeat issuers. And in the past, it used to be you had to have some sort of Norwegian content, but that is no longer the case. And so I think we've seen a lot of success with using the Norwegian bond market. At the same time, the U.S. bond market is clearly where the real depth of capital is, and so we have also seen several instances here in the U.S. high-yield bond market as well. And I suspect that as the fundamentals again improve in the sector, that there should be again opportunities for issuers to access both markets.
Would anyone else like to pick up on this point? In particular, the availability of the depth in the Norwegian market as we're talking about larger market cap companies and presumably larger offerings.
Yeah, I think Jay made an important point about the size of the transaction in Norway, where it's more, I won't call it bespoke, but it's something that can get done over there, whereas maybe in the high yield market or the debt market, you need a bigger size over here. So in that sense, I think it's very useful. If you look at the depth of the Norwegian market as it relates to equities or equity-linked products, it's certainly a market that can help get a transaction done, but it can't carry the water, so to speak. I wouldn't say, based on our own experiences. It certainly, like I said, it helps round out transactions, but going to a larger size, either equity raise or convert or whatnot in Norway would be a bit more difficult based on, once again, our experiences versus something in the high yield market.
Right, so the conversation has drifted a bit from equity to debt products in the Norwegian market and equity-linked products. Doug, you mentioned converts. Maybe do you want to speak to the debt markets or other sort of debt-like products that might be we might see more of going forward?
Yeah, sure. The debt markets first in the U.S., as mentioned, has to have a certain size, which oftentimes precludes some shipping companies from being able to participate. But there are alternatives, and one of the alternative products that we really like is a convertible bond. When you look at, and granted, everyday tanker stocks and wet cargo stocks have been ripping on a daily basis, but as you're kind of getting close to your net asset values, it's a nice instrument to be able to utilize and say, hey, look, I can get 3-4% money that if it were to convert, it would convert at 125-130% of net asset value. That's a decent alternative to something in the high single digits, which you might get in the public debt markets.
Right. Mike, do you want to name any favorite capital markets products?
Well, I think for us, the debt world, convert world, whether convertible pref or convertible debt, there's just a much deeper universe of investors. Now, granted, we're doing private placements, so we're not out there going to retail investors. So for us, that's sort of where it has to be. Common equity is not really something we're focused on, and I think right now that's sort of where the well of opportunities are.
All right. Christa, what are you seeing in activity in the debt markets?
I mean, I wouldn't say we have a favorite product. Citi can assist with pretty much any product in the capital markets, whether it's debt or equity or converts. I think convertible equity or convertible bonds can be interesting for the right size and situation with a shipping company. I think you have to be careful because sometimes the headline attractions of issuing stock at a certain premium, there's things about that structure that you really have to be careful with in terms of the dilutive effect on the underlying stock. But for the right company in the right situation, it can be very effective, and the markets are strong right now. I guess one thing that hasn't been mentioned is the structured debt institutional markets, private placements and project bonds. It's been an area where we've been pretty active over the first part of this year, setting up institutional debt. We placed a $1.1 billion project bond against an FPSO in offshore Brazil for MODEC earlier this year in a very successful transaction. And so there's very deep pockets of institutional debt capital for the right structures when you put an overlay and you have an asset in a long-term contract against it.
And Jay, would you like to add anything on what you're seeing in the debt markets and maybe even the private placement side of things that we have neglected in this conversation?
Yeah, I think we addressed the debt markets. I think what Christa is alluding to is there's a lot of private placement debt capital that's out there as well, and that is absolutely an area of focus. Project financing is something that we have seen a lot of interest in, and certainly related to what I would say wind, solar type projects. So our bank has been quite successful in those types of projects and deals where you have a very strong counterparty, strong cash flows, and you're seeing a lot of interest on the U.S. Private placement debt side. So that's definitely something that I would say we are seeing a lot of interest in. So that's probably one area of focus. I would say that's probably different from the normal way NOC bond, U.S. high yield bond that we've seen.
Great. Well, thank you all. It appears we're out of time. Do we have time for questions, or should we move to the next panel, Nick? Okay. Thank you to the panel.